Welcome back to Francois Entrepreneur, the show that turns complex investing strategies into actionable steps. I'm your host, Davidson. Today we're talking about one of the most reliable wealth builders, rental real estate. You're ready to jump in, but the market looks like a confusing ocean of numbers. How do you know which city, which neighborhood, or even which street is going to make you money? If you invest based on a gut feeling, you're gambling. If you invest based on data, you're building a lasting asset. This episode is your comprehensive guide to market analysis. We're going to break down the three most critical indicators for new investors: price trends, vacancy rates, and economic drivers. Stick with us. By the end of this 15 minutes, you'll have the toolkit you need to move from passive observer to data-driven real estate mogul. Our first segment is about understanding the market pulse. Every successful investment begins with rigorous market analysis. This isn't just checking Zillow, it's about grasping the big picture forces that drive supply and demand. What are the key indicators you must track? Rental price changes. This is your most obvious sign of demand. Are prices going up steadily, or are they flatlining? Steady, sustainable growth points to a strong, high demand area. Flat or falling prices, that could be a signal of oversupply or a local economic issue. Vacancy rates, this is arguably the most crucial metric. A low vacancy rate means demand is far outpacing supply. That's a landlord's dream. You can charge premium rent, and turnover time is low. We'll dive deeper into this later. Job growth, rising income levels, and major infrastructure or development plans, these are the magnets that attract tenants. No jobs, no tenants. Local regulations, rent control laws, or changing landlord responsibilities can quickly shift the profitability landscape. The takeaway here is that you must look beyond the specific property and assess the health of the entire local economy. Segment 2 focuses on translating those price changes into investment signals. Rising rental prices are great, but the key is asking, is this sustainable? Rising prices signal high demand and potential profit, allowing you to be more selective with tenants and secure your cash flow. But there's a risk investing at a market peak. If prices jump too quickly without the underlying economic support, you might be buying into a bubble. How do you spot a healthier market? You want to see price increases marching in line with stable or decreasing vacancy rates and strong economic indicators like job creation. When population influx, people moving in for jobs, supports the rent increase, you have a sustainable trend. Your action step: analyzing local listing data. You need to become a local data scientist. Track local real estate sites, but focus on the historical data. Look at year-over-year growth. Identify seasonal fluctuations. Compare similar properties to see if the asking prices are justified by amenities or just market hype. Scrutinize that data to ensure the area's price trends genuinely align with your long-term investment goals. Now, let's drill down on the vacancy rate. This number is your clearest snapshot of the supply-demand balance. The problem with a high vacancy rate, say above 8 or 10%, means oversupply. This spells trouble. It forces landlords to compete by lowering rents, eroding your potential income. It means longer periods with zero income between tenants, and it could indicate the area is simply not desirable due to economic issues or lack of amenities. The power of low vacancy: a low vacancy rate, generally under 5%, is a strong green light. It signifies high demand and limited supply. You can charge premium rents. You experience low turnover. It often correlates with economic growth and an influx of good, qualified tenants. This is the market condition that truly yields profitable outcomes. Data sources for vacancy statistics. Where do you find this vital data? Local government housing reports. These are often the most comprehensive official sources. Online real estate databases. Many offer neighborhood-specific vacancy data. Property management companies. Talk to local managers. Their anecdotal evidence on how quickly they can rent a unit is gold. Our final segment is the toolkit. You can't track these indicators manually. You need systems. Number 1, online real estate platforms. Use services like Zillow, Rent-A-Meter, and local MLS data. Don't just look at the list price. Look at the list to rent ratio and the time a property spends on the market. Number 2, economic indicators. Use the Bureau of Labor Statistics, BLS, for local job reports, and research municipal government websites for planned economic development projects or major employer moves. This is forward-looking data. Number 3, networking and local groups. Join local real estate investor associations. The ground level Anecdotal insights from people in the market are invaluable and often confirm or contradict the statistical data. Number 4, spreadsheets and templates. Create a simple matrix for every potential investment neighborhood, tracking its price growth percent, vacancy rate percent, and key economic drivers. This simple system keeps your analysis objective and structured. Remember, an investment property isn't just a house, it's a small business, and every successful small business runs on sound current data. We've covered a lot today. To successfully navigate the rental market, you must transition your mindset from emotional buying to data-driven investment. The key principles are: track all indicators, not just price. Ensure price increases are supported by sustainable economic growth. Treat low vacancy rates as your most profitable signal. By methodically analyzing price patterns, vacancy rates, and economic drivers, you dramatically reduce risk and maximize your potential for passive income and long-term wealth creation. If this episode has given you the confidence and the tools to start your real estate journey, here is your next step, your call to action: subscribe and follow. Hit that subscribe button right now on Apple Podcasts, Spotify, or wherever you listen. We release a new educational episode every week. Don't miss out on the strategies that build wealth.